Clock says that it is noon, so let's get started. We have a lot that we're going to be covering today. Thank you so much for coming. We really appreciate it. This is the second of 4 parts in our financial series. If you missed last week's, you'll be able to go to our website and see the recording. Today's topic is getting angels, VCs, and crowdfunding money. This financial series is all about finding money and also using it appropriately, spending it appropriately. We've got a lot to cover, so Boris, if you're there, give me a click and we'll go on to the next slide. Thank you. Just a little bit about SCORE. SCORE is bringing you this series, and SCORE is a nationwide nonprofit affiliated with the Small Business Administration. We provide free mentoring, and you should take advantage of that free mentoring because it's invaluable, and as well as educational services like webinars like this. Our Minnesota chapter has nearly 90 volunteers serving Manatee and Sarasota County, and we've been doing it for 50 years. You want to click, Boris? Thanks. Since its founding in '64, we've helped over 11 million clients. So where do we help you? At what phase of your business? Well, we help in all phases. Boris, could you click? Thanks. We help in all phases of your business, whether you're in a pre-startup, whether you're in your startup phase, maybe you're just opening, maybe you're in business and you want to grow your business and you're not sure how you can do it, or you're thinking about selling or closing your business. It doesn't really matter where you are in the process, we can help you. Apply for a SCORE mentor and you're going to be amazed at what we can do to help you. We encourage you to visit our website, which is at minnesota.score.org. There you're going to find opportunities for you to request a mentor, find a workshop or webinar event, locate podcasts, or look in our library for more resources. In fact, if you missed last week's first seminar in the series, you'll be able to go onto our website and click on locate a podcast or look in the library, and you'll be able to find last week's webinar. Lastly, we need to thank our sponsors. They help keep the lights on. These amazing organizations are what keeps us going. Well, let's kick into it. We'd like to welcome Boris Livschutz. He definitely knows his subject matter from the inside. He's from Silicon Valley and Seattle and now resides in Sarasota. He's worked for large tech companies like Oracle and has helped build several startups from concept to IPO, and is an angel investor. So if you've got a good idea, maybe Boris can help you. Boris's experience is in helping founders to understand current business and technology trends, executing on a technical vision, attracting angel investors, recruiting and scaling companies. If you apply for a SCORE mentor, Boris might be brought in as a co-mentor to help with your angel investing, if it sounds like a great idea. Thank you so much for sharing your knowledge with us, Boris. I turn it over to you.
Thank you, Dan. Let's begin. So let's see if I can go down here to the next slide. Okay. So today we're going to talk about, startups, and I'll define which startups I'm referring to. This doesn't apply to all startups, and the specialized way in which they raise money in today's economy. So we're going to talk about, as you can imagine, angel investing, crowdfunding, the general ecosystem of venture capital, and how they compare and which one to do, and how you can navigate the whole process, right? So that's the topics for today. And then we'll leave time at the end to ask questions. So you can queue up your questions in the chat window, and Diane will be reading them afterwards if you're the, one of the lucky ones she picks. Okay, sorry. So what startups am I referring to? A lot of you, who come to SCORE for Mentorship have great new business ideas and have started new businesses, whether it's the restaurant down the block or a hair salon or whatever it is, But today's talk isn't about that. We're going to talk about a very specialized kind of startup, not just someone who started a business, but, a very unique kind of startup that in this day and age has also unique way of raising money. And, if you're referred back to, last week's talk, there we talked about the general raising money for all kinds of businesses. So if you're in that category, definitely look back to last week. There's plenty of options for you. But today I'll drill down to a very, specialized part of the market. So what kind of startups am I talking about? These are high growth potential startups. So, your restaurant, your barber salon, are great businesses, but they can't grow that fast, which is fine for you, but they don't fit this market. We're talking about companies that can double and triple overnight, right? They involve innovation. So they need something new, really new, whether it's the product or the process or technology, right? But it's something really revolutionary that they're bringing to the market, which kind of goes to the high growth and these other points, right? They're capital intensive, to get started, right? So, if you can start your business by going and borrowing, $20,000 from your parents, right? Then you don't need to do all this. There's no need to, do everything we're about to talk about, right? These businesses usually require millions, tens of millions, sometimes hundreds of millions of dollars before they turn a profit, which is because they're driving innovation, right? And as we'll talk about, there's no early profits, right? So early profits, a lot of businesses can start and immediately make money, and that's the way most businesses want to run, right? But in this case, because you're trying to build something new, you can't really expect any profits right now. And because you want to grow really, really fast, that kind of contradicts the whole point of profits. The way to make profits is to grow slowly, right? And they cover a large geographical area. So, you're not just trying to conquer Sarasota or have the best 3 restaurants in Sarasota, right? These are people who want to conquer the world. If not the world, at least America. And if not America, maybe a whole chunk of America, right? So large geographical scope. And there's a large market size, which doesn't mean immediately you have it, but the product you're selling or the service you're selling has the potential, to be sold to a lot of people. And so, venture capital is looking for billions, and nowadays tens of billions of dollars in market size. We call it a TAM, a target addressable market. And you have a moat that goes back to the innovation before. The next guy who starts it can't easily compete with you. That you're creating a differentiator that's very hard to copy, right? So, it's not just a gimmicky concept, but you've spent a year building a new technology, and someone who comes next year will have a really hard time to get there. Right? So that's the kind of startups we're talking about. So if this is your startup, you're in the right talk. Congratulations. Okay, so let's start looking at some of these funding sources. We'll start first with crowdfunding. So what is crowdfunding? It's basically a way to raise money by tapping into a large audience, right? That's why we call it, crowdfunding, right? So online, social media, a lot of platforms, and you get a lot of people excited really fast, and they chip in some money, right? So you can reach out to the whole country or the world with some great idea, and they can chip in, and you can raise money that way. So that's the basics of crowdfunding, right? There's different types of crowdfunding. I'm going to talk about the 2 main ones, and I think the one that we're most familiar with is rewards based. So the nice thing about crowdfunding, we'll talk about angel investment later, but the nice thing about crowdfunding, you're not really, in most cases, especially with rewards based, you're not giving up any equity in your company, right? Which is a nice thing for most people, right? So basically, what is rewards based crowdfunding, right? It's you accept funding from people in exchange for some reward. So they're not really investors. They're just excited about what you're doing. You're bringing a new shoe or T-shirt to market, or some cool new thing that everyone gets excited about, and they want to see you succeed, right? They're not so much investing as just or as rallying behind you, right? And you're offering them some reward for helping you out, so they may get your product for free. Like if you're coming out with new T-shirts, right, or a shoe, they'll get the shoe or T-shirt for free. Rewards don't have to be big. If that's too expensive, you can give them a discount, a 20% discount to your product, or early access to your product, right? So small reward just to make them feel like they're getting something out of it, right? And this is great for startups who are in the in a creative space, again, where something is new and exciting and it appeals to a lot of people. Here's some examples of platforms, and we'll talk about some of these platforms. But really, the one we're going to talk about later is Kickstarter. Another type is equity. This is kind of less popular, I guess, but it fits a certain category, for some people, right? So this is not where you have investors, but these are small investors, and we'll talk later about accredited investors and angel funding. But this is a lot simpler. So people, for example, on AngelList, right? I think the minimum is $1,000. So you're not talking about big investors or rich investors. They don't have to be accredited. It is regulated by the SEC, but the platform takes care of everything. So again, you reach out to a large audience and people kick in $1,000, and they do get some equity in exchange. So you're giving up a little part of your company. So that's the only difference, right? But you're still appealing to a lot of people, but these people aren't just getting excited about, hey, your product, they're more excited about your business, right? So, you can choose one depending on what you're offering. So here's some examples again. Technical, there we go. So let's look at Kickstarter. This is one a lot of people have heard about. It's one of the largest ones for reward-based, crowdfunding, right? So what is a platform? It's just a place that takes care of a lot of logistics for you. And you set up your campaign there, and you say, okay, I want to raise $100,000, and I'm gonna like sell this I'm building this new kind of product, a new kind of shoe or something, and I think it's really cool. And you set up a campaign, and you say, we're going to raise $100,000 in the next 3 weeks, and then it's your job to actually to get people there, right? So people can go there and swipe their credit card and participate, right? And then you'll get a list who to send the gifts to, right? But you got to drive the traffic. There's like tens, hundreds of thousands of people on these things, right? So a lot of this is, we'll talk about this more, is really your ability to do marketing, right? So the key is to set a good goal, because it's all or nothing. Meaning, if you say I'm going to raise $100,000 in 3 weeks, if you get to $80,000, that may seem great, but they're going to refund the money to everyone because you didn't reach your goal, right? So it's all or nothing. So you should set smaller goals and just do more campaigns, right? Set something you can really reach, right? And then try to accomplish that. And here's the link to that Kickstarter. So what are some of the best practices, right? How do you run a successful campaign? So here's some ideas, right? So first of all, pick your model. Again, whether you want to offer rewards or equity in the company, figure out what's good for you. Again, depending on who you appeal to. Do you have a cool, sexy product, appeals to consumer kind of people, or do you have something that's a great business idea you feel people want to invest in, right? Select your platform. You can research, like I've given you a few, and they're a little different. They take different compensation. They look a little different, so look into these platforms. Set your target amount. Like I said, don't set it too high. I mean, set enough so the money is useful to you, but don't set it too high, because you can always do another campaign, because all these are all or nothing, right? Choose the compensation. Like I said, it has to make sense to you financially. So if you're offering a free T-shirt, make sure if people are giving, are chipping in $50, that T-shirt doesn't cost you, $25. That's pretty cheap, right? So that you keep most of the money, right? Make sure there's a good story behind this, right? People like to chip in money for a great story about how the founders were struggling until they came up with this, or how they got this great idea, or they were trying to feed the world. They're going to contribute some of the money to that, make it exciting, because again, you're competing against a lot of other stories, right? Learn from others. So check out, all these campaigns are online, right? See how other people raise money, see what's on their pages, see how they advertise, look at their social media, again, learn from which ones are successful, and try to use some of their key ingredients, right? You don't have to reinvent the wheel on these, right? These are going on every day, right? So you want to have the right mindset. Not everyone's going to want to invest. Not everyone's going to believe in you. Not everyone's going to like your product, right? Some people are going to, some campaigns won't work. So you just have to keep trying, right? As a startup, you face a lot of adversity, right? And now you're targeting the whole world. So there's going to be people who are poo-hahing the idea, right? take advantage of the start of the campaign. The first day is exciting. You're launching, and we'll talk a little about, but really make that the big launch event, just like you're opening a restaurant. That's the most exciting, day ever, right? You'll leverage the crowd. This is called crowdfunding for a reason. So as people get excited, as people get involved, ask them to share on their social media and tell their friends, what they're chipping in for, so they can bring in their friends, right? Use the virality of it all, right? That's really how it works in this world of crowdfunding, right? And finally, even though you may be targeting millions of people or whatever, right? Keep it personal. So people are going to ask questions. People are going to, ping you with questions and comments. So try to respond to those. Don't wait for 2 weeks and then try to answer it. Be responsive and really connect with people so they feel like there's a real person behind the story, right? So a lot of the success of this is marketing. So if you're great with marketing, you're going to love this. Just like marketing your product, when you're selling it, you're marketing this campaign, right? So take this campaign, think of it as a product, and market the heck out of it, right? It's that should be a strong point if you're going to do crowdfunding. This is not a one-to-one kind of sales operation, right? So you want to make sure you're good at marketing, or you have someone on your team that's good at marketing, or you hire someone that's good at marketing, because that's really what it's all about. So you want to have a website, your own website, or a specialized one for this campaign, or at least a landing page where you can tell the story and point people there as you do your marketing campaign, right? You don't want to just market Kickstarter or something, right? You want to develop your social media, and we've had events and SCORE, and you can take those on marketing. I'm not going to get into all the best practices of marketing, but basically, leverage your network, everyone use social media, try to really get out there. Do a press release. There's really an expensive way to press release. So announce that you're starting this campaign. Make it really big, even if you think like it's not that big. So make it look like a serious thing that everyone in the world should hear about, right? You're starting your campaign. Use email marketing. See if you can reach out to to people that might be interested in this, and by gaining certain kinds of lists, right? And leverage the platform. These platforms will charge you some fees, and they provide you with apps and all kinds of tooling. They want you to be successful, right? So leverage those platforms, make sure you understand what's available, and try to leverage that, to get the most benefit you can, and try to reach the largest audience you can, right? So I kind of talked about Kickstarter. I want to talk about AngelList, because this is a kind of this is the main one for equity, based crowdfunding. So AngelList has been around forever, in Silicon Valley, right? And instead of, as we're going to talk about, targeting specific angel investors who may know, this is a way to target every angel investor around the world, right? Or at least in America, right? So it's a way to hit a lot of them up, and they don't have to be big angel investors, right? Again, I think an angel is like usually all these campaigns of $1,000 will do it, right? So again, on AngelList, you can learn the platform, but there's a way to create your profile, make sure it's all nice and clean, really explains who you are, who the company is, etc. Find a good refer, right? Like if you're trying to get 1,000 people to invest in you, they're not all going to call you and ask you for a reference. That's not how it works, AngelList. You upload their refers, someone that can really talk about you. So make sure you find a good person. All those people can contact them without asking you for one, right? Again, you want to leverage your network. So, make sure everyone is hearing about this and they're talking about it. So, something like this is well suited for LinkedIn, right? So you want to announce it to all your friends on LinkedIn. You want them to, reshare on LinkedIn that you're running this AngelList campaign, some hot startup, a chance to invest, something like that, right? So, you don't have to get all new marketing. You can leverage your own network, right, in this. And use your profile as kind of the executive summary. So everyone should go to your profile to understand what this company is all about, right? Again, be responsive. People are getting, especially here, people want to invest $1,000 or $5,000. You want to answer their questions, get back to them soon. To show you're a serious founder, right? You want to look for a lead investor. There's I won't get into the minutia, but these things have syndication. So there are lead investors who kind of are out there on AngelList, and they have a mailing list, and they tell their followers, who they're investing in. The followers can follow them, and they'll do most of the research work. So if you find a great lead investor, he can bring in his own, his own network, right? You know, then you got to fill in the rounds. So whatever you want to raise, and here it's not winner, I mean, all or nothing, but you know, if you're trying to raise whatever, just, you know, raise as much as possible, you know, reach out to investors and, you know, keep it going. And the more you raise, the more popular it'll get, and people will see their success and they'll jump in, right? So just, you know, keep on it and, you know, don't give up, right? And keep the profile active even after you're done. You may want to do another one. People want to keep in touch, and you never know how useful some of these investors are. So keep in touch with your investors, right? So that's AngelList. Let me minimize this. So if you look on the right side, there we go. So let's talk about angel investing now, which is very different than crowdfunding. Angel investing is a one-by-one approach. So you know, who is or what is an angel investor? Well, you know, they all look like that guy on the right. Well, maybe not, but you know, you'd be surprised how many people are actually doing angel investing nowadays. You know, the only real qualification is now is because it's SEC regulated, they need to be an accredited investor, which means they need to have a certain amount of income every year or a certain amount of assets that doesn't include their primary house. So they're wealthier folks, but otherwise, you know, anyone could be a angel investor, and they provide you with, you know, financial backing of a small startup, right? Or you as an entrepreneur, right, in exchange for ownership in the company, right? That's all it is. It's basically an investor, right? They're called angels because they're individuals, and we'll talk about venture capital later, but really they're not part of a company or investment organization. They're on their own or part of a club, but they invest their own money and not someone else's money. How do you find these people? Well, you'd be surprised, you probably already know them. I mean, they're your neighbors, your coworkers, your bosses, your doctors, lawyers, you know, dentists, anyone that, you know, has a reasonable amount of wealth is eligible to be an angel investor. You'd be surprised how many people are already investing, because they all want to invest in the next Facebook or Uber or whatever, right? So it's not really hard to find them, honestly. I mean, you know, look around you, right? So that's one thing. They're in your network already, and you know, you want to look on LinkedIn and try to reach out to them. They move in herds, you know. So while there are some that just do it on their own once in a while, a lot of them like to be in groups. They can help each other, and you know, the different angels, different areas of expertise, and they can work together and share the work. So you know, we'll talk about Sarasota as a group, but you know, every city usually has a bunch of angel groups, and some of them are theme based. You know, they only invest in green technology. Some of them invest only in women. Some of them invest only in aerospace. So you got to find the ones that match you. And you know, if you Google around, you'll see thousands of angel groups, right? If you look at, there's resources. So as I said, there's Bridge Angels, which is the Sarasota group. It's only well, it's the main group in Sarasota that focuses on pure startups. And you can definitely reach out to them. There's definitely more outside Sarasota, right? If you want to kind of try to you know find more resources, I've listed some other things. There's kind of an association that they'll try to you know match you up with other angel groups. And there's this other one that's been renamed, I guess, to AngelSoft, you know, which is a way to try to you know, get your pitch in front of you know, a lot of these angel groups. I mean, the problem is angel groups, right? They usually have a website, you can upload your pitch to them, and they'll decide whether they want you to present. And usually, if you're successful, you can, once a month they meet, and 3 founders will make a pitch, right? So it's a lot of work trying to get in front of them. And then, you know, there's EDC, other government organizations that can try to help connect you, etc. There's also incubators and accelerators which connect you to investors. So, you know, in Tampa, there's Tampa Wave and other incubators, accelerators, which will take you in for a few months, and they'll give you advisors and help you otherwise with your startup. But one of the things they do is introduce you to angels in that community. So in Tampa Wave, they would introduce you to all the angel investors in Tampa, right? That participate in that program, right? So, you know, one thing to look into is if you want to, you know, join incubator or accelerator. So how does all this work with angel investors? How does the whole process work? You know, how do you go in front of them? How do you get them to invest in you, right? Well, let's go into that, a little bit of that. So, you know, like I mentioned, first you find them, right? And once you find them, usually you have an initial meeting. So you reach out to them if it's an individual. You ask them if they have time for a short meeting. If it's an angel group, they'll organize a dinner or something where all their members are at, and they'll give you a time slot. So usually it's 20 to 30 minutes for the pitch. You know, you've all seen Shark Tank, whatever. So it's not that bad, but you want to make a pitch, and we'll talk about your pitch deck, but you're going to use your pitch deck, a PowerPoint slide like this, and you're going to explain the story, your company, and why they should be excited to invest in you, why your business will be successful. For those who are interested in going further, they're going to ask for a follow-up meeting. And those are more of a deep dive that can be an hour, 2 hours, whatever it takes. And they're going to ask you specific questions and things they're not sure of, and they'll really you need to really know your stuff and be able to defend your startup, right, and how it's going to do against competitors or etc. If they're at that point, if they're interested in investing, then you negotiate terms. A lot of times, angel investment, not much negotiation, but if there's a big investor, he may ask for certain things. Otherwise, we'll talk about you have a standard agreement. Everyone's signs it, and the terms we'll go over. And then there's due diligence. So they don't just hand you over the money. They want to see if everything you said is actually true. So you create what's called a data room, and we'll talk about that. It's with a Google Drive. You put all your documents there. Hopefully, if you're working with your score mentor, you have QuickBooks and you have a P&L and everything like that. So you show your accounting, and you show you really have the customers you have, and you have the the money coming in that you have, and how you're spending it, etc. And you have IP technology, all that kind of stuff, right? So you prove everything you said is true, and once they're satisfied, you send the documentation to sign. Usually it's DocuSign. They sign the documents. You send them wire instructions, and these people all wire money, and people don't write checks anymore. So you send them wire instructions from your bank. They wire the money, and there you go. Now you're not done. You will definitely want to keep in touch. I always get quarterly or monthly updates from all my founders I invest in, because they may need stuff from me. They may need my help in something, or they may need me to invest later on. So you definitely want to keep your investors happy and informed, so you don't just take the money and run, right? Usually this takes a few months, if you do it well. I've seen some people take years, so there's no guarantees, but if it works out, it usually takes a few months to find some angel investor, angel groups, and you raise a few $100,000. Some people less, some more, right? And then you rinse and repeat, meaning, if you need more money and you're not ready yet to go to the venture capital, you can do this again. So it's not like once you've done, you can never do it. You just need to find more angels, right? So you go to new angels, or you ask your old angels if they're going to invest more or not, if they've seen your progress, right? So you can keep doing this. So, but before you go, just like any business presentation or any launching a new product, you want to be prepared. So this is something really important. Have all your ducks in a row. There's a lot to this that you need to get ready. So the first thing is the pitch deck, and I'm going to talk about this a little bit later, what goes in, but it's a PowerPoint. You don't want to make it too long or too short. It should tell an amazing story that people feel they have to invest in, right? This is gonna be next Facebook, or this is gonna be next Oracle, right? So you should really put a lot of effort in the pitch deck. This is like your resume. It gets you in the door. I get pitch decks every day, and I don't have time to read most of them. I skim them and etc. Right? So you really want to get the pitch deck as good as possible. I mean, no one's going to invest in you based on your pitch deck, but it will get you the next meeting, right? So that's first of all. The second is legal. Once you go to angel investor, remember, this is not fun and games. You're not SEC regulated. You're raising money. You're Wall Street, right? So you're no different than mutual fund or something. So this is covered under SEC, and you don't want to go astray of that. So this is not something you go on LegalZoom and download some template, right? You need a lawyer. It's not that expensive, and usually this costs maybe a few $1,000s to get all your paperwork and everything ready for investments, but it's money well spent, because if anything goes wrong, you'll never get any further, right? So you need a lawyer who has experience in this, and you can work with your score mentor, to find one of these. You don't need to be, but you should be a Delaware C Corp. Most seasoned angel investors want to see that, because LLC is very hard to provide them the right kind of equity. So eventually, if you look at Silicon Valley, eventually when they go to venture capital, they're all Delaware C Corp. In Delaware, they have good rules for handling businesses, etc. So you need to be structured correctly. You need to have a lawyer, and you need to have all your investment documents ready. And we'll talk about, there's two main structures for getting money. It's either a safe agreement or a note, right, a debt note, right? But either one of those documents, so investors can read something, review it, and sign it, right? And that's what protects them to make sure they get their equity when it's time, right? Financial accounting, again, they're going to ask you, even if they agree to invest, they're still going to ask you for a data room. They want to review your financials, and you should show that you know how to do financials. Otherwise, how can they trust you to build a big business, right? So hopefully you've been working with your SCORE mentor, on bookkeeping and finding a bookkeeper or CPA, using QuickBooks or something like it, and keeping track of your financials. You shouldn't have receipts in your pocket and at your desk, right? Should all be well organized so you can impress these investors that you can run a business, right? And then all this goes in the data room. So your data room should be ready. That's just a Google Drive with documents inside of it, and all these documents that come from QuickBooks, and if you have customers who signed a purchase order or something, that should be in there. If you have any proprietary technology, your IP should be in there. Your patents, anything that you've claimed to your investors that has value should be in the data room. And if it's confidential, you can have them sign NDA or at least limit the information to, right? And again, intellectual property, if you do have patents, usually you only have the money for provisional patents, but they should be done. The provisional patents should be done to impress investors that you have something special and defendable, right? The whole patent process is a very lengthy conversation, but I'll leave it at that. Okay, so let's jump into pitch deck. This is, I get pitch decks every day, and most of them are horrible. I've had Harvard Business School students send me, 80-page pitch decks like on War and Peace, and I just don't have time to read it, and it's not very impressive. If a founder, can't even do PowerPoint, right? Do you really want to invest in them? So, it's like a resume. If you've ever been a hiring manager and you get resumes and people can't even spell words right, you really want to hire that guy. So you should really put a lot of effort in your pitch deck. Here, there's no hard rules, but here's generally the flow of it that angel investors expect to see. First slide is the problem. What problem in the world are you trying to solve? So maybe there's, if you're making a new kind of syringe, maybe a lot of people are dying because they're getting injected from something wrong. What's the solution to the problem? Well, if you're making a syringe, maybe, the right kind of smart syringe will help avoid this problem. What's the product? Well, let's look at the actual, syringe or, software. Let's look at your product. So there you can show us a screenshot of your product or explain the features it has or something. So the solution is a general solution to the problem, and the product is a deep dive into the actual product you've been building, right? Competition. So the first question people are going to ask is, well, who else does this, right? So you want to show competition, you may have a little graph or a little chart on features that competitors have, list your top competitors and how you're different than them. Market, how big is this market? You don't want to be in a market where even if you sell to everyone, it doesn't get you very far, right? So show how big your market is, the TAM, target addressable market. So if you're coming out with some new, some new kind of software for doctors, well, if every doctor bought your software, how big would that be? And then, the go-to-market strategy. So, okay, now that you've built this or plan to build this, how are you going to get out there? How are you going to launch and get money out of this, right? So what's the strategy? Are you going to build a sales force? Are you going to digital marketing? You're going to use Facebook ads, viral marketing, whatever. What's your strategy, to bootstrap and get out in the market? You need to show that you've thought through the strategy. The team, if your team is famous, I'd put the slide a little bit higher. If your team is not, a little bit lower, but who's the team? Who are the founders? Any big shot engineers or advisors? Anything you can impress people with, right? Traction. what progress have you made? So traction is usually the sales, right? Have you sold anything? Or have you got some commitments from anyone? Or are you doing a demo somewhere at least? Show some traction that this product's, somebody has bought this product or really wants to buy the product, right? Financial projections. So, everybody wants to see this. This is kind of a little fluffy because obviously if you just started and you haven't sold anything yet, it's pretty hard to do projections, but everyone wants to see at least a 3-year projection. So to keep them happy, you show a chart that next year you're going to do this much, this much, this much each year. The component of it doesn't have to be accurate, probably won't be because you can't predict in 3 years how a product will sell that you've never sold before. But it has to be defendable. So if you claim in 3 years you're going to be at 20 million in revenue, you need to be able to justify it and defend it, right? So you have to explain, okay, this many people are going to be using it because I did this much marketing, or I have this many sales guys, or has to add up to that number, right? You can't just throw out a random number, even if it is random. And then what are you doing with fundraising? So you're presenting to an investor, but how much you're trying to raise, how are you going to use the money, how long will it last? What's going on with this fundraising round? Who's already invested, or how much has already been invested, et cetera, right? And then the last slide is always the vision slide, right? So you want to show how big. You may have a little product right now because you only have a few guys and $100,000, but if you're able to get big, like how far do you want to take this? Do you just want to be a little startup, one day, or do you want to conquer the world, right? And certain investors, are okay with small because it's easier, it's less threatening. You may sell your software only to a certain subsection of the market, right? Or you may want to be the next Facebook, so you should explain your vision so the right kind of investors can get in. So if you do have a wide vision and you do want to conquer the world, right, you're going to attract, those kind of investors, and this will eventually really help you. You're going to do this over and over to, if you succeed with angel round, you're eventually going to go to seed and Series A and B. We'll talk about. So the vision gets really important because they want to invest in unicorns, and the unicorn, it comes from that vision slide, right? As every unicorn, began with some dinky little product and a few $100,000, right? Keep in mind that investors are looking for the three T's I talk about, right? So there's team, traction, and technology, right? So that's what we want to really focus on. The team, the people who are building this company. This is a company, not just a product, right? The traction. Are you proving that you can sell this product? Will anyone ever buy this product? And the technology, like what's defendable here? What have you built that differentiates you from every other company that's going to come along, right? So keep in mind the 3 T's, right? So you've got your angel investors, they want to invest. How do they actually invest? How do you do the paperwork? So again, you're a lawyer and I'm not a lawyer, so I'm not going to give you legal advice here, but I just want to give you the basics just so you can think about it when you do go to your lawyer, when you talk to your investors, right? This day and age, whether it's Silicon Valley or anywhere else, there are two, they're mostly 2 common agreements, and one is called a SAFE, which stands for a simple agreement for equity, and there's a convertible note. Convertible note is the older one, has been around forever. A SAFE is newer, just to have less legal work and simplicity. So there you just sign a 3-page piece of paper saying, I'm going to give you $25,000. And right now I get nothing in return except this piece of paper. But when there's a priced round, when you go to venture capital, then it'll convert into stock, because then there'll be stock and the venture capital will price the round, properly and whatever. And the convertible note is really the same. It's an agreement, but there it's like a loan. It's structured as a debt. So you actually are borrowing money and then eventually it'll convert into stock. So in the meantime, you're owed some interest rate, So it's a more complicated document, but it's supposed to be it's more investor friendly because you get some interest rate as you're waiting. Usually angel investors in Silicon Valley, the typical check size are 25,000 to 100,000. Once you get over 100,000, you get into institutional money. Under $25,000 is not worth the founder's time. Now, in places like Florida here and others, things are smaller, and so I've seen people take checks of $5,000 and $10,000, right? You don't get to small because you have to, to go through all this legal work, right? That's why if you want very small amounts, you can do AngelList that we talked about before and get smaller amounts, just a lot more people, right? So there are two things you kind of negotiate or have to think about in this agreement, and it's really, how much you're giving away and how much you're valuing the company. So there's a valuation cap, and it varies widely, but generally, in Silicon Valley, there's 6, 8, 10, $12 million, going up right now in this bubble. So you have to establish a value for your company for the investor to invest and understand how much he's getting, right? So a valuation cap, let's say of $10 million, if the investor is investing 100,000, well, that's 1%. So he knows he's gonna get, 1% of the company, right? The discount ranges from 0 to 25%. And the reason it exists is because, again, right now you're not receiving any, or you're not giving any equity to anyone you're signing an agreement. It'll be based on the future round, right? Maybe the next round when a price is established. That's why this is not referred to as a priced round. Institutional money, usually they're not going to sign these agreements. They want a priced round, so they do a much more complicated agreement, but then they establish a price. They establish a valuation. They say, okay, we're going to invest in you and your valuation is 10 million, right? So you as an angel have come in early. So, the valuation cap protects you on the high side. So if you get a much better valuation next time, right now you're at 6 million and the VC comes in 12 million, right? Then you're good because you get equity, based on the smaller number. If it's a down round, so if the guy gets carried away and, if you have a high valuation cap of 10 million, but then the next round, the price round is at 6 million, right? Well, the investor doesn't want the 10 million because, the VC, he came in at cheaper. So he's going to get, the better of these two. So discount is saying if the next round is below the valuation cap, you get a discount off that new amount. So you're still better off than the venture capitalists who came in later than you and took less risk, right? So that's the general parts of it. I know it's a little confusing, and you can read up on this, but basically, these are terms you're offering your investors. So now let's go venture capital. So if you're successful, you raise money from angels. The next step, we need more money. It's probably too much for angel investors to chip in. If you need millions and millions, you go to venture capital, and they're only different angels. They're institutional money. So they're not individuals. They're these companies who have their own investors, like pension funds, whatever. It's really a subsector of private equity. So it's not some mystical thing. Private equity has been around forever. It's an investment category like stocks and bonds. It's an alternative asset class. Many wealthy people like Bill Gates or, has money in various private equity. You've seen them. They're the ones that, buy out like Hilton and bring in new management, turn it around and bring it public again. In this case, it's a subsector of these venture capitalists are specialized in startups, right? Nowadays they come in all sizes early on, and there's pre-seed and seed, and then there's series A, B, C. So microseed may only invest like $250,000. The seed may be $500,000, $1 million, etc. So generally, if you don't get into all this, in Silicon Valley, people raise a few $1 million now at the seed round once they're done with angels. Here in Florida, maybe smaller, like $1 million or more. But basically, you approach these organizations, and there are thousands of them now in America, and you can look them up. And they also have different themes, and they have partners. They may have a few partners. Each partner may specialize something different. One, consumer, one networking, one software, one hardware, etc. You find the ones you think are a good match, and you reach out to them. These again are priced rounds, and we've talked about it before, right? So they establish the price of a company if angel investors have not in the past, right? And so they negotiate the price of a company and they invest based on that price. So if they say, we believe your company is worth 8 million, let's agree on 8 million. If they invest, $4 million on top of that, right? They're going to get a third of the company because now it's worth, 12 million. And they've invested 4 million. So that's how it works. And then all the angels will unravel from their safe agreements and get their equity from that. They get preferred shares. I mean, the same as angel investors, actually. Employees get common shares. Founders get common shares. Preferred shares just mean, it's the same as the stock market. Preferred shares means the company is liquidated. They get their money out first, whatever's left, and then the common shares get out. Once you go public or something, all this converts into the same shares. But preferred shares also have voting rights, higher voting rights, so they can fire the founder or whatever. They get a board seat. Usually at Series A, you get a board seat. So they want to exercise some amount of control because they're giving a lot of money to maybe a young founder, and so they want to be able to steer the company. So usually by Series A, you start giving board seats on your board of directors. And basically now the founder has a boss. So angel investors, they can help you or not help you. You can listen to them or not, but they don't have much control if they don't like the way you're going. But usually by the time you get into Series A, at the very least, you have a boss and they can fire you and they can outvote you, right? So you have to be ready for that. Usually it's a good thing because they have hopefully a lot more expertise than you do. This is maybe your first startup and they've invested in 20 of them and maybe they already had 1 or 2 successes of their own, right? So they're like the parent and you're like the kid, right? So if that works for you, then this is the path to go. So which one do you do? We've talked about 2 very different kinds of models, right? One is, crowdfunding, one is angel investing. So you can do both in theory, but it really depends on, a few factors. So one is kind of yourself, right? Do you have a large network, or are you great at marketing? So if you have a large network, if you know a lot of wealthy people, right, it may be a lot easier for you to go out there and get, 20 checks from angel investors instead of running all this marketing. But if you're really good with marketing and attracting hordes of people who you don't know, then crowdfunding may be better for you, right? It's also what kind of investor do you want? Do you want a high net worth individuals, or do you want just everyone around the world, randomly, chipping in, right? Due diligence. Are you ready to stand up to what I talked about, the data room, right? Or investors who are experienced pour through your numbers, right? And this doesn't mean a negative thing. It doesn't mean you're a fraud or something if you're not ready. Sometimes you're just not ready at this time and point. You may be ready in half a year once you get your accounting in order, right? So in crowdfunding, like no one's going to do much due diligence. Depends on the product. Does the product appeal to the masses, right? Then crowdfunding may be good. If it's a very specialized product and you need investors who really understand the space, right, then maybe angel investing is better. Assistance, crowdfunding gets you money and nothing else, right? You maybe have 5,000 people that chipped in and you don't know any of them, right? Whereas angel investors, you may pick people that are experts in your field and they don't just invest, they help you, right? And then, time, right? Crowdfunding, you can set up a 2-week campaign, get over with, and if you're successful, you get the money. Angel investing is a lot more complicated. You have to meet with everyone, do second meetings, data room, everything. So, it usually takes at least a few months, right? So it's a longer timeline. The cost, angel investing is free. You may have to buy them lunch or something. But on these platforms, they charge a fee. They charge a percentage usually, right? So you're going to give up some of the money on the platform. And then equity, do you want to give up equity in your company? So crowdfunding, we talk about the reward side, you can raise a bunch of money and never give up any equity. Obviously, angel investing, it doesn't work that way. There's some books you can read. Well, there's a lot of books you can read. Here's a few of them. If you want to learn more, see people's experiences, or read from founders, venture capitalists. And again, we'll have these slides later, so you don't have to rush to write this down. These are some of the famous books. And now I'm going to turn it back to Dan.
Hey, Boris, can you hear me?
Yes.
Okay, I've lost all of the controls. My Zoom would like to crash. So unfortunately, you're in charge of any questions. Can you see if there are any questions?
Yeah, there are 2. Well, there are 2 in the chat and 2 in the QA. So let me should we go to the QA first? Here. Get my glasses here. I have a small concrete, company, business. So I'm just reading this. So there's demand for the product and services Annual income of 150,000 first year. First year, there's 300,000 second year. Sorry, first year 150,000, second year 300,000. And then 600. So I don't think I don't think this kind of funding would work well. If you refer to our presentation last week, I think if you have a construction company or a concrete company, things like that, I think traditional funding going to banks and stuff, they'll understand it better. And it's more traditional, mainstream, local business. So I would definitely, focus on that. Scroll down here. Sorry, that question was from David. Another question from Stephen is, be very cautious of Middle Eastern loan scams. Yeah, so look at your emails and obviously be careful of. There's a lot of VCs in America. And from Kia, could you please go back to one of the first slides that that list some of the websites. Yeah, these slides are going to be available, so don't worry. And then there's a question from Maria. Can you do a crowdfunding for a specialty food type? Yeah, for specialty food type bistro self-serve. Yeah, you can do crowdfunding for everything. It's just about marketing, right? So if you have something to offer people and they want to see you successful, you can do it. So you can offer them some of your food or recipes or something like that. I think that's all for that. Let me see in the question, sorry, the chat window.
Boris, you have done a great job in defining the difference between crowdsourcing and angel investing. There's so many resources available, but I hope that everyone will take an opportunity. We're going to be sending you, of course, the PowerPoint slides as well as the video. So you'll be able to review all of this in the next few days. You should be getting that probably tomorrow. You'll also be getting in an email an evaluation form, and we hope that you take a few minutes to fill that in. We're always trying to improve our offerings, not only suggestions on how this can be improved, but suggestions on future offerings, so that when we're putting our calendar together, we can look at what you're in need of, and we will try and find a presenter to present that to you. Were there any more questions, Boris? I hate to leave you hanging like that. I'm sorry.
No, yeah, there in the chat there were some questions about slides and recording, so I think we covered that. So yes, there will be a recording, there will be slides. So I'm not going to go back in the slides, but trust me, you'll get the slides. And again, if you have any questions later, if you have a SCORE mentor, they can put you in touch with me or answer your questions. If you don't have a SCORE mentor, we definitely recommend you get one, because they can help you a lot of this. I know there'll be a lot of questions. We went through a lot of stuff, right? So I think that's all the questions I see right now. So, a lot of people, I think, are wondering if they have this kind of business or that kind of business, or this kind of patent. Again, I would ask you to kind of, review this with your SCORE mentor, and, it's hard to answer just offhand. Again, there are a lot of great businesses out there. They're not all, really suited for this kind of investing, and it's something you can work with your SCORE mentor on, preparing you for this, or telling you that maybe there's a different path forward, right?
All right, well, I thank everyone who came to this. I hope that you have next week's on your calendar. As I said, this is part 2 of 4. So come on back. This was all about raising money, and then the next 2 are all about knowing where your money goes and how to spend it wisely. All right. Well, thank you, Boris. You did, of course, as usual, a fabulous job, and thank you for participating.